Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are going to be revising the chapter 8, which is equity finance. So this gives you all of the background behind, all sorts of equity that can be there when you're talking about any business. So the number one that we talk about, there can be two kinds of sources of equity finance. Number one can be internal sources, how you internally raise on equity, and how there could be external sources of raising equity also. So firstly, talking about the internal sources. So for your internal sources, the number one thing that you have is your retained earnings. Retained earnings is basically any accumulated profits that is there with the business. So over here, you will have no issue costs because this money is readily lying with you. Then also, this does not affect your shareholdings because you're not going out in the market to raise more equity. There are no new shareholders, no new dilution of controls. So it does not affect your shareholding. Then let's talk about one more very important thing, which is called the pecking order theory. Pecking order theory basically gives you an order basically to give so that you're able to raise finance efficiently. So according to this theory, the order goes like this. Firstly, every business should prefer to finance their needs with retained earnings. If they do not have that, then they should go towards debt. And if they cannot even go for debt, only then they should go for fresh equity issue. According to the pecking order theory, equity issue should be the very last preference. First preference is internal funds, that means retained earnings, otherwise debt, otherwise fresh equity issue. Now, there are two justifications which are there with this theory, that why this theory is telling you to prefer equity at the end. Number one thing is that it takes into account the cost, time, and expense of issue. So as you go down this sequence, at the top, the cost, time, and expense is lesser. In the medium, it's there, but in the end, it's very high. Equity is the most expensive to raise. It is the most time consuming and also is expensive when you talk about in cost of capital terms. All right. And another justification over here being asymmetrical information. Now, what is asymmetrical information? Basically, the information that the managers know and the information which the outsiders know. So managers, probably they know favorable information about the company, even though the company has been making losses in the previous years, but it's going to get a good project which is going to make the profits boom. So the managers know this, but the outsiders do not know. So they will feel that the company is undervalued because the company has the potential to do so good in the future. Outsiders who may have unfavorable information or who may not know this favorable information, they may think that the company is overvalued. So whenever a company goes to raise equity, this asymmetrical information may cause a company to be able to raise lesser finance at a lesser valuation. All right. Now, the second aspect, like we were talking about the internal sources of finance, first we talked about retained earnings. Second aspect is your working capital management. So this is a potential internal finance because any cash that you're left with, whatever your operating cash flows are, if you just subtract your interest and your taxes, any money that is left over with you can be used as a source of finance. So this is another aspect. Now, if a company wants to improve their working capital management, these are the possible improvement areas. Number one over here being reduction in amount of inventory. Another improvement area could be reduction in time taken to receive payments. And last but not the least, taking increased credit from suppliers. So these are a few improvement areas if a company wants to improve on the working capital management. Now we have spoken about the internal sources. Now let's move towards the external sources. So when we talk about external equity, in external equity, we are first talking about the listed entities. So for listed entities, what are the possible sources of raising external money? Number one, they could do an offer for subscription. What happens in an offer for subscription? It's nothing but a public issue. It's a direct sale to the general public, and it is the most expensive method. It is the most expensive method. So these are the characteristics. Another source which they could potentially go for is do an offer for sale. Offer for sale is nothing but an indirect sale to public. What happens over here is instead of selling it directly to the public, they sell it to any issuing house. Issuing house could be any merchant bank, investment bank who guarantees to buy and sell the shares to the public. So if the public is not subscribing, this issuing house is going to buy the shares of the company. So this is another method. Even if the company does not want to do this, there are more methods. There's a method called placing. What happens in placing over here? There's going to be a sponsor. Sponsor usually is going to be a merchant bank. They place the shares with their own clients. Who are the clients of merchant banks? Merchant banks have their clients as pension funds, insurance companies. So they, being the sponsor over here, will sell the shares of your company to their own clients who are pension funds and insurance companies. This is the least expensive method. This is one important characteristic. Moving ahead is the rights issue. Rights issue over here is nothing but the offer to allow existing shareholders to buy shares in proportion to their existing holdings. So whatever shares they are holding now, they will be getting the proportion in the same, same proportion they will be offered to buy rights issue. Then let's talk about offer for sale. This is another method. Over here, what happens is there's an auction. Public is invited to bid, and this is public comes for bidding. And then one more characteristic which you should remember over here is that this is more useful where setting share price is difficult, where you do not know what is the price of your shares, where should you price it at. So you can go for an auction. The shareholders, the people who come for the bidding, will themselves decide a price. Now this is all that we talk about regarding listed companies. Let's talk about the options which will be there for the unlisted companies. So if I do not want to, if I'm not a listed company at the moment, what are the options for raising equity for me? Number one, I can get quoted. Either quoted means I can get an IPO and get listed on the stock exchange. And the second method is to stay unquoted. And if I stay unquoted, what options do I have? I can either go for a rights issue or I can have a private placement. So this is what are the options for unlisted companies. Now that we spoke about IPO, let's suppose I am an unlisted company and I want to go for an IPO. What should be the factors that I consider before doing IPO? So number one thing that I'm going to consider is going to be the legal restrictions. Then I will also see what are the costs of doing the IPO. There are all sorts of costs like underwriting, stock market listing fees, issuing house fees, printing and distribution of the prospectus, advertising in newspapers, so all sorts of fees. Then number three, I will also see what's my valuation like, at what price should I be selling my shares on the market. And then number four would be the stock exchange rules. What rules do I have to follow once I get listed on the stock exchange? And last but not the least, I will also consider the timing. If I go on to issue my shares when the market is rising, there's a good tendency that my shares get listed and also rise with the market. And if vice versa is the case, then I might want to postpone until the market gets stable. Now, let's also talk about one very important concept that we have in this chapter, which is called TERP. This is nothing but the theoretical X rights share price. This is the expected share price after a rights issue. So what share price can a company expect after it has done a rights issue? So the formula that we have for this is pre-existing value of equity plus the proceeds that you get from this rights issue plus, let's suppose you're doing any new project, so the NPV of that project. This is what your numerator is going to look like, and you divide this whole thing by the number of shares after the rights issue. So this is what the share price of the company is going to look like after the rights issue has been done. There are a few more formula associated with the same concept. Value of right per share can be computed as TERP minus subscription price. And another formula, value of right per existing share. How do you work this out? It's nothing but the value of right per new share, which is what we did over here. This needs to be divided by the or you can say multiplied by the ratio of the rights issue. So if it's 1:4, so it will be 1/4, 1:2, so 1/2. This is how you have the TERP concept. Now, let's also talk about more sources of finance. You would have heard about bonus issues. So bonus issue, also called as a scrip issue, and it is also called as capitalization of reserves. Capitalization of reserves. So what happens over here is that all of the reserves that you see in the company's balance sheet, any reserve can be converted into share capital. So over here, there is no finance that is raised. No finance is raised. It's just that there was some thing in your balance sheet which you have taken from one place to the other. So the reserves that you had lying extra with you, you have converted that into the share capital. Basically, this is good news about a company. It increases the marketability of the shares. All right. How does it increase the marketability? By the way, because while doing a bonus issue, the number of shares that are now available in the market, that increases. So the share price actually goes down a little bit because now in the same market, more units of that thing are available. So it increases the marketability when the share price is beyond certain level. Perhaps let's suppose the share price earlier was 10,000 and now it has probably come down to, let's suppose, 8,000. So a lot of people who earlier could not spend 10,000 to invest, they would now be able to enter. So this is how marketability gets increased. Now let's talk about another concept which is called a stock split. What happens over here is that the ordinary share, let's suppose my ordinary share was valued at 1 rupee. I will simply split its value. Let's suppose this one share that was there for rupees 1, now I am converting it into two shares which are 0.5 rupees each. So the one share which I had now has gotten converted into two shares of 0.5 and 0.5. This is how ordinary shares are split into value. This reduces the market price per share, and also this helps with increasing the marketability. All right. Now we come towards discussing dividends. So with regards to dividends, the first thing that we will discuss is going to be the practical influences on dividend policy. What are the practical factors that influence the dividend policy of a company? So number one thing is your legal constraints. There are when you talk about majority of the countries around the world, they have regulations that dividend can only be paid if there is credit balance in your retained earnings account. If your retained earnings account does not have a credit balance, you will not be able to pay dividends. Maybe you want to pay a dividend out of a reserve. You cannot do that until and unless you have a balance in your retained earnings. Then second thing that influences is your liquidity requirements. Businesses may want to hold cash for quick investment opportunities. So if I do not have enough cash on me, I will not pay a lot of dividend. Then the next thing is the shareholders' expectations. What do my shareholders expect from me? So I will have a look at my dividend payment history. If I am a regular payer of dividends to the shareholders, I will have to continue to do so. Otherwise, my shareholders may get upset. Signaling. Basically, this is called signaling effect. What happens over here is, let's suppose I surprise cut dividends. That means I reduce the amount of dividends that I pay. So it becomes a sign of liquidity problems. The shareholders or the general people in the market are going to think that probably the company is facing liquidity issues. Or if I do a surprise increase in the business, then it is going to show, it is going to signal to the people, to the shareholders, the strength of the company. So this is what the signaling effect is. Number 5 over here is the stability. Companies thrive to be stable. They want to have a stable level of dividend or at least a constant growth rate so that they are avoiding any sharp movements in the share price. Last but not the least is your borrowing covenants. Covenants are nothing but the restrictions which any financial institutions may place. Let's suppose I entered into a loan agreement with a bank, and in that agreement there's a clause which limits the amount of dividends that I can pay. So that is also something which is going to practically influence the amount of dividend that I pay to my shareholders. Next, let's talk about the alternative dividend policies. So what are the possible dividend policies that a business can actually adopt? Number one policy is to pay a constant dividend. So over here, let's suppose if I've decided that I'm going to pay rupees 50 as the dividend every year, this is going to remain constant no matter what happens. So what's the benefit over here? It avoids surprises, it signals stability, and shareholders may be disappointed if the company has done extremely well in 1 year, but still I'm only giving them 50 rupees of dividend like every year. Second policy is the constant growth. So over here, you make the dividends predictable and favored by the shareholders. Let's suppose I have announced that every year there's going to be a 5% growth in the amount of dividend that I pay to my shareholders. Next is maintaining a constant payout ratio. So what you do over here, you have decided a proportion. Let's suppose 40% of my total profits are going to go out as dividends. So a constant proportion of earnings are paid as dividends. Another policy is the residual dividend policy. What do you do over here is that your earnings are used to fund all projects that you have with positive NPVs. If you are left with any money, if you are left with any profits, only then you will be paying out dividends. All right, this is the residual dividend policy. Now we move towards the last alternative policy which we have. This is called the zero dividend policy. Like the name suggests, there's going to be zero dividend in given by these companies. So maybe if you have a high growth company which if you're investing in the early years all surplus of cash that can be profitably reinvested back in the business, then the business will have a zero dividend policy. Now, there are a few dividend theories also. Dividend theories tell you whether dividend actually impacts the shareholders or not. So, let us go by these theories one by one. Let's first talk about the clientele theory. So, like the name suggests, clients. Who are the clients of the company? It's assumed to be the shareholders over here. So, the clientele theory basically says the different kind of people who are holding shares in your company, it is dependent upon them whether they, are happy with the dividend or not. So, if you talk about pension funds, these pension funds usually invest heavily in shares that will be paying regularly dividends and relatively predictable dividends because these pension funds have pension payments to make. So they will prefer investing in companies that pay regular, predictable dividends. So if a company has such investment funds, pension funds as their clients, then the company should maintain a stable dividend policy or they have a risk of losing out on major investors. So clientele theory basically tells you have a look at what kind of people are the investors in your company. If they are people who need a regular dividend, then pay them a regular dividend. If you think they are okay with not getting dividends, then you can omit the payment of dividends. Another theory is the bird in the hand theory. Bird in the hand theory, as the name suggests, tells that the shareholders actually prefer to have higher dividends and therefore lower capital tax because cash dividend today is without risk. And maybe the company grows in the future, maybe it does not grow. So, bird in the hand, whatever the shareholders are getting now, they prefer that. Then we have another theory, which is the dividend irrelevance theory. Like the name suggests, this theory suggests that it does not matter to the shareholders whether you are paying the dividend or not. If the company is not paying dividend, then the share price will go up due to reinvestment. If the company pays dividend, like if the shareholders require dividend and the company is not paying, they can sell a part of their holding to have a homemade dividend. Homemade dividend means that the company has not actually given any dividend, but you have sold, let's suppose I hold 1,000 shares in one company. The company is not giving a dividend. Let's suppose I bought the shares at 50 rupees and now the share price is 70 rupees. So I can probably sell 100 shares and whatever gain I have made on these shares could be a homemade dividend that I have created for myself. So these were the dividend theories. Now, let's get to alternates to cash dividends. So, if a company wants to pay dividends but it does not have a lot of cash, so what are the options? Alternatives to cash dividends. Number one alternative is to have a share buyback program. What happens over here is a company can decide a fixed price or buy shares from the general open market at the market price. What will happen over here, because the company is buying the shares from the open market, in the market fewer shares will be available. So your share price goes up. Because the number of shares is now reduced, your EPS as well as your return on equity goes up. So now whatever shares the company has bought in, these can either be cancelled or they can be held in the treasury for further issue. They can keep it with themselves if they want to reissue it later in the future. Then the second option is a special dividend. What you do over here is to avoid, let's suppose you have had very good profits in this year and you are not sure whether this increase in profits will continue for the future, but you want to share these profits with your shareholders. So what you do over here is you give it as a bonus dividend. This is a special dividend separate from your regular dividend, just so that you avoid raising the expectations of the shareholders. And last but not the least point over here is that your all shareholders are going to receive cash. Another last alternative which we will discuss is called a scrip dividend. Scrip dividend, basically here the company will give you a choice. If you are a shareholder, they'll give you two options. Either you can take the cash dividend or you can take shares in lieu of cash. So whatever is the worth of dividend, they will give you the number of shares that can be bought with that amount of dividend as a dividend. So over here, what happens? All the shareholders who are going to prefer this option over cash, the company is able to conserve cash for reinvestment. All right, so these were the alternative to cash dividends. Now let us move towards the very last concept that we have in this chapter, which pertains to SMEs. SMEs, I'm sure you would have heard, are small and medium enterprises. So what are the features of SMEs? Number one, they are likely to be unlisted. Likely to be unlisted. Their ownership is likely to be restricted to few individuals. And then last but not the least is that they are not a micro business. Micro business is any business that a person has opened to remain self-employed or probably employs just one or two more people apart from that. So it's not a micro business. So these are the characteristics that you will find in SMEs. Now this chapter, since we're talking about equity, SMEs find it difficult to raise finance. Why do they face a difficulty in raising finance? Number one, it's because of the perceptions of risk and uncertainty. SMEs have a general perception that they will be risky companies because these are small businesses. No matter how much good they are doing, something unpredictable, uncertain can happen, because of which they might make losses. So there are perceptions of risk and uncertainty about them. Another reason why they find it difficult to raise finance is because of absence of security. That means they do not have a lot of assets which they can give as a collateral to obtain loans or any finances. Then the shares that they have, they lack marketability. Because they are not listed, they cannot be easily sold off by the people who give them money. So the shares lack marketability. This is another reason why they find it difficult to raise finance. Then there are tax considerations. And then last but not the least, you have a funding gap and a maturity gap. Now let's break down these two terminologies one by one. Funding gap basically is the gap or the difference between the finance which is available to them and the finance which they can productively use versus finance that they can productively use. This is called the funding gap. And when you talk about the maturity gap, it's basically meant that long-term loans are easier to get than medium or short-term loans, because long-term loans can be secured by mortgages against property. Hence, financing medium-term assets with short-term finance like overdraft is something which causes a maturity gap. You should be financing long-term with long-term and short-term with short-term. So this causes a maturity gap. Now, what are the financing solutions which are available to SMEs? Through what means, what are the measures through which they can also obtain loans or finance? So, number one option that they have is that of venture capital, VC. Venture capital is nothing but, there are people who invest in companies, so they will want a product with potential. If I'm making something that has a potential to do well in the future, investors would want to invest in my company, or if I'm doing some sort of innovation. Number two is that I should have a solid management. These are the characteristics that any venture capitalist would look for before investing in my company. Number three is that I should have a potential for high return. I should have a business plan for my business. And then the venture capitalist should have an easy exit route. If he finds all of these things, it is very likely that a venture capitalist is going to finance the SME. Second is your private equity funds. Basically, who are these funds? These are companies who will gain control of your company to restructure, and then they will sell your company once they have done the restructuring. If there was something wrong with your company, once they have corrected all of that, they will sell your company to another fund or get it listed on the stock exchange. So they gain control to restructure, and then they sell to another fund or list on stock exchange. All right, moving towards the third alternative, there is a concept of business angels. So, business angels are a few private individuals who invest in small businesses with big potential. And the benefit over here is that not only do you get the funding, they help you with the advice, they help you with their experience, and they help you with their business contacts also. So, this is what a business angel will help you with. Number four is government assistance. How can government help SMEs? Government can help SMEs by providing grants. They can help as a guaranteeing of loan. They can guarantee to the bank that if this SME does not give you the money, I will give you the money. So this way they find it easy to get loans. Or the government can give them tax breaks or any other tax incentives. The government can also help them by providing advice. And if the government prefers, they can also do an equity investment in their company. So this is about government assistance. Last, very last, and with this we are done with this chapter, is crowdfunding. So over here, basically, there will be one project initiator. So if I am holding a company, I will be the founder. I am going to be the project initiator. There's going to be a platform on which I get my idea to the people. And if the people, the masses who are also a part of the platform, they are there to support ventures, so they can come on these platforms to support me. So this is what crowdfunding would look like. There are a few types of crowdfunding which can actually be there. So the number one is your donation based. This is primarily done for charities, not for profit organizations, or for disaster relief. Secondly, you have reward based donation. Over here, there is actually no debt or equity which gets raised. It's just a pre-selling of goods or services. Products or services. And then last is your equity based, where the people who support you, who give you money, are going to receive the shares. So these are the types of crowdfunding. With this, we are done with chapter number 8 pertaining to equity finance. I hope that this video was helpful for your revision. I will see you in the next one for the next chapter. Thank you for watching.